This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
This episode is brought to you by the Felder Report. I go through a ton of reading and research every day, and on Saturday mornings I send out a free email newsletter with the 5 things that I found during the week that were the most valuable to me. It can be a link, it can be a chart, it can be a quote, but I keep it brief, and it's just the stuff I found was most valuable. So if this is something that you'd like to receive, just go to thefelderreport.com. You can sign up right there on the homepage, and you'll be good to go. My guest for this episode is Meb Faber. And you'd be hard-pressed to find anyone who's done more recently to educate and inform individual investors about the fundamentals of effective investing. Over the past decade or longer, through books like Global Asset Allocation, Meb's taken key concepts which Wall Street has suggested for years are too complex for individuals to understand, let alone implement, and made them easily accessible for almost anyone to quickly absorb. In this conversation, Meb discusses why passive investing as we know it is not nearly as efficient as most people believe, how owning just one fund allows them to be far more effectively diversified than investors who own dozens, and why the investment industry as we know it today is in terminal decline, and how investors and finance professionals alike should position themselves to take advantage of its evolution. So, without further ado, please enjoy my conversation with Meb Faber.
Ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered.
Hey, Meb, welcome to the show.
Great to be here. Thanks for having me.
Yeah, no, I'm super glad to have you. It's I've been reading your stuff for a super long time, and I'm just really glad to have the chance to introduce you to my audience and a lot of your concepts and things that you've been writing about. I was looking at your bio a little bit, but just to kind of prep for this. And I noticed you have a degree in engineering, science, and biology. Was that stuff you were just kind of interested in studying, or were you kind of initially planning on going into a career in that field?
No, I wanted to study aerospace, and I started out aerospace engineering, where I came from a family of aerospace engineers. My old man and brother were Lockheed and Northrop guys, and got to college and realized very quickly that wanting to become an astronaut was not the same thing as aerospace engineering. Way more math, statics, dynamics. I said, this is not what I signed up for. So, kind of fumbled around for a year or two. Eventually, I remember reading Watson's Recombinant DNA. I was living in Boulder, doing summer school at CU. And fell in love with biology and all things genetics, and that kicked off a path down that route. And as careers go, winding and meandering, that's probably more my hobby these days than my career, which is investing in finance. But certainly fell in love with all things biology and genetics.
So, biology is, I guess there's, I could see the kind of engineering background in a lot of the stuff you write that, a lot of the quantitative things and stuff, you can really tell it's kind of comes from an engineering background. But the biology, what is there kind of an overlap in between biology and investing that you see, or anything that you've been able to apply from your biology, interests and study?
I imagine I could come up with all sorts of theories about natural selection and everything else. It's always like, all these articles, there's like, investing is like sailing, or investing is like poker. It's like, right. You could probably come up with some analogies, but, in general, there's a lot of parallels, I think, on capitalism, maybe as a broad market force, and the free market versus kind of how things work in the natural world of survival and business models and ideas. And that plays out in all sorts of different ways through investing in broad markets, in individual securities. There probably is a great deal. We could get pretty deep quick. We're 5 minutes in and we're already getting into some pretty deep topics. But I think there's probably a lot in the way that you think about survival, whether it's one company. If you look back in the ranks of companies in history, it's pretty hard to simply survive in markets. The biggest compliment we give people in the investing world is not returns or anything else. It's simply like, did they survive? And you mentioned the writing, and I laugh because it's like saying doctors have good handwriting, engineer being a good writer. I look back and haven't been writing since pre-crisis, and I sort of cringe certainly at my writing. Very, very quantitative in nature, but you look back at some of the articles from 10, 12 years ago, and half the links don't link to anything. Half the companies don't exist anymore. Half of the money managers are long gone. So I think this concept of simply staying in the game and surviving, which I think there's a lot of parallels to natural selection, as well in genetics, I think is probably a pretty accurate representation.
Yeah, I mean, you write about the values of diversification a lot, and not just diversification across securities, but across different asset classes, across different strategies. Even, I mean, you take diversification kind of to an area most most investors don't even think about. But I mean, I think that to me just is a lesson. The biodiversity and those types of things are really what make ecosystems more. I guess resilient and those types of things. And so I just, that kind of just comes to mind. But what was it, I guess, that really, turned you on to investing? If you were kind of studying engineering and biology and whatnot, I mean, what was it that kind of really caught your attention about it and really inspired you to kind of move in that direction?
I grew up during the romping, stomping bull market. I'm sure much as you did, 80s, 90s. Time of Michael J. Fox's Alex Keaton, exactly. for the older crowd listening, the gray hairs and no hairs listening, younger people have no idea what I'm talking about. But, there's always curiosity. I think a curious child in general, loved all sorts of different things, but investing was always a hobby, through high school and college and thereafter. And like most, learn by making all the mistakes and doing all the dumb stuff. Thankfully, while I was young and didn't have a whole lot of money, but the progression of, I think, making a lot of those mistakes, living through my favorite bubble, the late 90s internet bubble, was just getting out of university, and in making all the mistakes is what eventually pushed me down the path of being a quant, which is what I consider myself now, and kind of quant light, just meaning that there's rules and everything we do is rules based. But starting out with somewhat of a, and I have a postcard when my father passed away years ago. We found that was written to him about talking about investing, and thinking we should buy some shares of Disney and Anheuser-Busch, which was kind of hilarious. And we eventually looked back at how my picks would have done, and I would have been much better off foregoing an entire career and investing and just investing in those a couple of stocks and going away and not focusing on it, which is ironic and not so much in many ways. Anyway, but like most young people, I think it was a meandering, bumbling path that was not necessarily totally planned out as a young fella.
Yeah, I mean, sure. I studied English in college, but I gravitated to investing because it was something that I was always interested in, and it was the kind of the roaring 90s at the time, in the late 90s. But so where did you, I guess you graduated from college. Where did you get your start in the world of finance? Was it at an investing firm, a broker dealer?
So the year was 2000, and my brother, who had gone through grad school, PhD program, said, Meb, maybe you want to take a year off or two, make some money before you go back into this. Because in life sciences in particular, PhD can take 4, 5, 6, 7 years. I said, that's a great idea, particularly because all my friends have moved west. It was the gold rush. Times were booming in San Francisco in the late 90s. It's hard to, I guess this cycle is probably pretty similar, but it feels like the late 90s one was much more fun than this one, bubble. Anyway, so everyone was moving to San Francisco. I had the opportunity to work for, kind of combine my two passions at the time. I was still fully on the path of going down biotech, and so had the opportunity to work at a broker-dealer that managed a biotech mutual fund in Washington, D.C. It was actually in Maryland, that allowed me to go to school at night at Hopkins. So it was really a perfect setup. Loved it. Again, this was in 2001. So at a period where really the ending of the bubble, and many characterize that bubble as the internet bubble, which took down a lot of market cap weighted securities. And there's some similarities and rhymes with today, but a lot of people also forget that it was very much a biotech bubble as well. This was when the human genome was being sequenced for the first time, both with the U.S. government as well as Celera Genomics, Craig Venter's company. A lot of optimism and excitement about genomics in general. So I was right at the intersection, man. Undergrad degree, going to grad school in biotech, interested in investing. I used to walk down to all the FDA drug approval meetings in my spare time. And so anyway, but got to see that implosion. And then thereafter, decided I wanted to start gravitating more and more towards investing. Going to take maybe another year off before finishing grad school. 1 year became two became three. I was out in San Francisco, a brief stint in Lake Tahoe, where my resume says I was working for a quant shop, but I think it was probably better characterized as ski bum, but quant by day, ski on the slopes by 1 p.m. And then moved down to SoCal. And started Cambria in 2006, and been here ever since.
Yeah, so it's funny that you mentioned the human genome stuff. I guess I sort of forgot about that. I was I co-founded a hedge fund in the late 90s, and one of the reasons I left was because we were supposed to have a value bent, and we ended up owning stocks like Human Genome Sciences. And, so we had my partner and I had some disagreements about the mandate of the fund.
Bill Hazeltine, the CEO, very charismatic. I took a security analysis class in the spring of 2000 I went to undergrad at Virginia, and it was taught by a hedge fund manager, multi-billion-dollar hedge fund manager, former Tiger Cub. Human genome, and the final for the project was you were supposed to present a security long or short. And at the beginning of the semester, I had chosen HGSI, ticker symbol, at the time, and I think the thing went up like 120% by the time I presented, and then back down like, another 80%, all within one semester. Was learning a lot in real time, but that name definitely brings back memories.
Yeah, for sure. I mean, it was wild times. There's so many names that I forgot, but yeah, it brought back that memory. So let's talk about Cambria. What was it that I guess inspired you to start the firm, and to start your own firm in the first place, and then really to start a firm that specializes in kind of a unique area of the investment business? Really, kind of what was the inspiration, I guess, behind it?
Yeah, so I mean, the idea in the origins was I had a lot of ideas kicking around in my head, and having spent kind of the formative years of the 2000s developing a lot of these, and Cambria has been around for 12 years at this point, so a lot of them have been developed and refined since then. But the base foundation at the time was really a quantitative approach to markets, and in this case was a lot of ideas around trend following. And so we had started the firm, didn't quite know what we wanted to look like when we grew up, knew we had some money management ideas. My partner came from a VC transactional law background, so complementary in many ways. And neither of us had ever started a pure asset management business. And so on the RIA side, and so we started out with some private funds and separate accounts. Very quickly at the time, you mentioned, started writing, and then realized that the opportunity in offering funds broadly, publicly. So we started sub-advising on a fund, and then said, hey, we should probably do this on our own. And fast forward now, we have over 12 ETFs across all sorts of different strategies. The commonality, of course, is they are quantitative or rules-based, but quite a broad spectrum of ideas. And most of them, tend to fall under this banner of being, like you alluded to, kind of weird, concentrated, and different. But the origins certainly were trend following, and that often, in many ways, still distinguishes us in a lot of our strategies. But kind of the two pillars, if you had to say what are they, here, it's on one hand, it's value, On the other hand, it's trend following to investment ideas that, we didn't invent. They've been around for over a century at this point, back to the time of Charles Dow and Ben Graham. But started the firm, started offering some of these ideas with the goal of building them out. And, fast forward, I think we have well over 30,000 investors at this point. So there's a few crazy people like us in the world, I guess.
Well, there was something else that I think you tweeted about recently that made me, think about you starting your firm too, which was, I think you said, the traditional advisory business, or traditional kind of money management business is like a terminal short these days. The industry is just changing so much. So I guess kind of in the context of that idea, there's obviously a niche that you found for Cambria that you think is kind of maybe the way forward for, investment companies. So I guess how do you see yourself as being different, and what do you think is the reason, behind a lot of traditional, I guess, asset management businesses, falling to the wayside?
So there's been this spectacular trend particularly in the United States over the past 5 decades, and it's slow and glacial, despite what I think a lot think, and that trend is kind of resulting in where you find yourselves today. That there's never been a better time to be an investor, and if you're an investor and you want to open a brokerage account, you don't have to pay commissions. Vanguard, for example, has trading where you can invest in ETFs and not pay commissions. Same thing with Robinhood and a bunch of others. Go back 3 decades, and my Lord, how much did it cost to transact in securities? It could be hundreds of dollars. It could be percentage points. So that's one. On top of that, the cost of actually investing, if you want exposure to, say, I don't know, 20,000 securities around the world, you can essentially get that for free. Where a lot of these market cap weighted funds from Vanguard and others may offer it for, say, 5 basis points or 0.05%, which is essentially, in all reality, essentially free. So awesome. You have this amazing selection for investors. You can get tax efficient vehicles. You can invest in, the largest grocery store on the planet. There's tens of thousands of these funds. That's the good news. The bad news is the world is still dominated, and Wall Street and finance is just littered. You just got to be careful with predators, across the board. Some know they're predators and some don't know they're predators. But, the way we always frame this is, the investing and asset management world, all that matters is your returns after all the costs. So trading, fees, management fees, taxes, everything that's involved. And of course, with a nod towards the risk you took to get there. And that's all that matters. And so the base case, we often say at this point, day and age, is essentially free. A lot of the asset management world is not prepared for that. The average cost of a mutual fund today in the U.S. is still 1.25%. I did a tweet this past week where I was talking about asset allocation funds around the world. And when you say asset allocation fund, you mean literally they do nothing. That's kind of their charter. They buy a bunch of assets, they sit there. Around the world, in every country, I think outside the U.S., the average fee is well over 1%, and some it's over 2%. And by definition, that's just a major cost and drag on future returns. So you don't have to pay anything to invest today, which is an astonishing development, but people still do. And the analogy we give is we say, look, I wish that we could wake up tomorrow and everyone would rush into these low-cost funds. That would be awesome. But I think it's a multi-decade transition where, the old phrase or adage that science progresses one funeral at a time. I think that's what happens in the asset management world where, if you hold an S&P 500 fund that charges you 1.5% and your partner dies or your parent dies or grandparent passes that along, No one goes back to paying 1.5% for an S&P fund when the alternative is zero. So they get sold. I wish it would all happen with a huge catalyst tonight, but I think the reality is that it plays out over a generation or two, sadly. Now, let me make a huge caveat here, because a lot of my friends in the asset management world, I have no problem with fees. If you're an amazing manager, if you have special ability, if you're targeting an asset class that no one else targets, like trailer homes in Wichita that's inefficient and you make 20% a year, God bless you. You can charge 1.5, 2, 3 percentage points a year. As long as you're doing that in an inefficient market, I think that's totally fine. There's some of the best hedge funds on Wall Street that can charge 2 and 20 if they're good. The problem is it just creates it's like a high jumper, a pole vaulter. It creates a bar that's just that much harder to get over. And that applies to everything. It's not just management fees, but it's also taxes and everything else wrapped into it. So the long-winded conversation is Vanguard announced this past week. You can go set up a digital account, and all in, including fund costs, is 0.2%. And they'll automatically rebalance. They'll be tax efficient, all that good stuff. And that's good news for everyone, except the people who charge a lot for doing nothing, which in reality they should go out of business. So I'm very positive on the developments. I think this is wonderful, not a bad thing. But I think that goes back to the old Jeff Bezos quote of your profit margin is my opportunity. And if you look around and the landscape of 150 industries we have in the U.S., well, what's number one, or certainly in the top three, is asset management as far as profit margins. So a lot of fat to be cut.
Yeah, and it's in terms of not just active managers, but also I think traditional advisors too. I talk to a lot of advisors, and a lot of guys I think are struggling because not only where we are in the cycle. But also how do they, try and justify an advisory fee for just managing, a portfolio? So
we often say advisors are worth their weight in gold if they do something, and this applies to active manager mutual funds and everything else too. So if you're trying to be future proof, if you're looking around today and you're a young person planning out your career, probably don't want to be a truck driver. That career, that profession probably won't exist in 10 years. It may exist in 5, but it certainly won't exist in 20. And if you look at our world of investing in asset management, do I think human advisors are safe for our lifetimes? I do, but you better offer some value. And that's the problem, is that, you can get a sort of a call center CFP at Schwab, and what is it? It's $20 a month now, the subscription service. So do I think advisors offer a ton of value if they do things like, yes, absolutely, but they have to be doing estate planning, wills, trusts, insurance, asset allocation correctly and thoughtfully. The behavioral coaching side is not to be dismissed. I think educating an entire family on the behavioral side and psychology of investing and dynamics of money within a family is important. All those things, huge value add, and the traditional advisor costs 1%. But you have to do it. And the reality is many don't. I know plenty of advisors that, they're done by noon and go play golf, and they put people in a lot of these traditional wirehouses. The all-in cost for many of these, 1.5%, 2%. And that's a huge drag on performance. And a lot of people, the most brilliant thing Wall Street has ever done has been to create the percent-based asset management fee, because no one sees it and it gets skimmed off the top. I guarantee most people listening, if you said, hey, you got to go deliver, instead of it just getting skimmed off every month in your brokerage account, if you got to go deliver your asset manager a briefcase with $20,000 every December, would you do it? And most probably wouldn't. And forget 20, someone maybe $200,000. But because you don't see it, it's a lot easier to pay it. But it ends up being a really massive drag on performance.
Yeah, you were talking about how fees have just changed so much. When I got into the business, I worked for a couple of guys at Bear Stearns who charged, it was either $200 minimum commission or 6 cents a trade generally. Yeah. And all they did was buy and sell stocks for accounts, and it's changed dramatically since then. And, then 20 years from now, it's going to look dramatically different than it does today. So, I mean, that was one of the things I was going to ask you is for, young people that are looking to get into finance, where do you think there's a, good opportunity?
Well, let's channel Charlie Munger, and basically one of the most brilliant people on the planet. If listeners, if you haven't been to Omaha, or more easier accessible would be the Los Angeles Daily Journal meeting. And Charlie's no spring chicken. I think he's got to be in his 90s now, but his mind is still as sharp as anyone on the planet. When someone asked for his advice, he said, "Look, if you're a fisherman, you go where the fish are, where there's no competition. If there's 500 of us up in Oregon on a bank when the salmon are running, that's a lot harder than if you're on a river when there's no one." And so, being the 200th analyst that covers Apple, are you really going to have an advantage here? Any sort of value add? Probably not. So, in the U.S., that means small cap, micro caps. It could be an area that no one focuses on. Maybe if you're local in Louisiana or somewhere and focusing on local companies, it could be, the old school Jim Rogers looking around the world. Maybe you're focusing on companies trading in Eastern Africa, or, the sort of emerging markets of Asia, or an asset class that no one's really interested in. Who knows what that may be? Maybe you're rolling up Instagram accounts. I mean, it's just focusing on ideas that not everyone is pursuing, because again, kind of going back to what we were talking about, this Death Star of fee compression in the asset management world, incredible thing for investors, savers, consumers, but for the broad-based assets, and even a company like ourselves, we try to exist in a little corner of the world that doesn't compete with Vanguard. Because if they come into your world and compete, you're just going to get obliterated, because they have way more resources. And the same thing applies to anything. It's any industry. Many people are seeing it, of course, with Amazon and a lot of other industries. So I think the advice is to seek out your own path and find, and it could also be industries too that no one's covering or interested in, that is not broadly competitive. So to compete against where there's no competition is what Charlie would say.
Yeah, I mean, it makes sense. And you mentioned your little corner of the investment world. I think if we were to kind of maybe broach the subject, some of the topics and books that you've written on kind of help people understand what that corner is. You recently did a poll too, asking people what's, if you could give one investment book to somebody, who's maybe a young person trying to understand how to manage their own money, what would it be? There's a lot of great investment books that people come up with. There's tons that, I recommend. But there really aren't a lot of good, books that really cover the basics, the fundamentals. The one that came to my mind was Global Asset Allocation. I think it does it. I think it's, if there was one book I could give to investors trying to understand the basics of putting together a diversified portfolio, I can't think of a better recommendation than that. So was that really your inspiration behind writing that book? Was, hey, look, there's kind of a void here to be filled. Why don't I write something about this that's kind of easily approachable?
First of all, thank you. And listeners, one of the big benefits of this book is it's free. So if you go to our website at CambriaInvestments.com, you can download it and a couple of other books for free, mainly because I have a large tiff with Amazon, but not the point of your question. So it was actually, in like many of our avenues of research, it was born of a different question, and a head scratcher, where every day in the media you see famous, not so famous investors, prognosticators, gurus, people all across our spectrum recommending investments. And in many cases, you have them recommending asset allocation. So think about someone says, hey, I think you should put 60% of your portfolio in U.S. stocks, 40% in bonds. And, maybe Merrill Lynch comes out with a report and says, no, we're really bullish. We're raising our strategic stock exposure from 60 to 65. And you've actually had a lot of incredibly famous and successful investors that manage in the trillions cumulatively recommend an asset allocation for individuals. So you've had people like David Swinson, who runs the Yale Endowment, in one of his books, Recommend an Asset Allocation, you've had Rob Arnott, you've had Mohamed El-Erian, Ray Dalio runs the largest hedge fund in the world. All these guys at some point have said, including Warren Buffett, here's a recommended asset allocation that I think the broad base of investors should implement. And so my thought at the time, I said, okay, well, let's go actually see how all these done. Let's do a horse race. Let's see how these portfolios have done over time, kind of compare them and see, just see what we can tease out of this data and learn. And so we took it back to the 1970s, early 70s. You can actually take it back to the 1920s if you make some additional assumptions, but there's some main asset classes, about a dozen: U.S. stocks, small caps, foreign, emerging, gold, bonds, real estate, commodities, all that good stuff. And in the first takeaway, the good news is they all kind of move up and to the right, meaning over time you get paid to own these assets, which makes sense because why would anyone else buy them over time? But you get paid to own, the big three in my mind are, of course, stocks, which is you're owning businesses. You're tagging along with this growth of companies and innovation and other people's hard work and sweat. And then you could also be the bank, so lending, essentially investing in debt, whether it's corporate or sovereign. And you could also real estate, which is kind of a combination of the first two. You invest in land or in real estate businesses, whether it's single family homes or corporations, yada yada. You invest in all these things. How do they do? And there were some really profound takeaways. So if you go back to the 1970s. And you look at, I think we did about 15 or 20 portfolios in the book. We had some more in the appendix. I can't remember. And what you found is they all did great, and they zigged and zagged all over the place. But the most interesting takeaway was that despite the assets having totally different paths to over the course of, 5 decades now, that they basically almost all ended up in the same place. So you had a spread of, if you exclude the permanent portfolio, which is Harry Brown's old portfolio of a quarter each in stocks, gold, bonds, and bills, it's not quite fair because it has a ton in fixed income. But if you look at all the other portfolios, and these are hugely different. Some said you should put 90% in stocks. Some said less than half, only 25%. Some says you should put 25% in gold. Some said zero. Some said you should put a ton in foreign, some zero. So you expect these to have massive differences and impacts on performance, when in reality, they almost all ended up in the same place. And the spread between the best performing and the worst performing asset allocation was under 200 basis points, 2 percentage points over time. And if you exclude permanent portfolio, I think it's under 1%. And this is an interesting takeaway. And I said, okay, hold on. Let's do a thought experiment, because this is a bit of a head scratcher, and I did not expect this outcome. I said, everyone else would assume that there'd be massive differences in performance because that the underlying instruments were so different. But you said, okay, let's go back to 1972, and we'll let you pick, listeners, your single favorite, the single best performing asset allocation over 50 years. And you take a time machine, how much, channeling Michael J. Fox again, different movie, Back to the Future. You go back to the 1970s, I'll let you go back and invest in the single best performing asset allocation. How much would you pay for that, right? Or time traveling DeLorean? Well, you'd probably pay $1 billion because you could start a money management company and invest in the best performing asset allocation in this book. But the caveat was you have to implement it through the average mutual fund fee of today. So again, we were talking about, go back to the 1970s, forget about it. Index funds hadn't even really been invented until the middle part of that decade, or low cost investing. So the average mutual fund fee today of 1.25%. So you go back to 1972, walk forward to 2019. The problem is, just by implementing it with the average mutual fund fee today, so forget the 1.5 to 2.5%ers, the average mutual fund fee today would have taken the best performing asset allocation that you picked in your DeLorean and transformed it almost into as bad as the worst. And that to me is a super profound, no one else thinks it is. I think it's one of the most profound findings of my entire career, which was just by implementing your asset allocation with the average mutual fund fee of today, not of 1973, you've rendered the entire asset allocation decision totally meaningless. It didn't matter how much you had in gold or stocks or foreign stocks or bonds or real estate. Just by implementing it with a higher, not even a high cost, but an average cost structure, made the asset allocation totally meaningless. And now, of course, if you said, no, I don't trust myself. I'm jumpy. I chase fads. I panic and crashes, recessions. So I need to hire a financial advisor of 2019 at 1% a year. So all in, you're at 2.25%. That takes the best performing asset allocation portfolio in this book with perfect look ahead, forward bias, and makes it far worse than the worst. And so that trying to let that sink into people and really explain the importance of the headwind and just slow drip of this cost of fees is really important. So anyway, the takeaway is that we, again, going back to full circle to our earlier part of the conversation, for kind of your core exposure, for your asset allocation, today you can buy a fund, ETFs. We manage the lowest cost ETF in the world allocation category, and add on the fact that many of these funds do short lending and return it to investors. There's many funds out there that are pretty darn close to 0% fees, and in some cases have negative fees because of the short lending revenue. That's pretty cool. Not only is it free, you're actually getting paid to own these funds. Why would you ever pay more? Why are there people still paying 1, 2, 3% per year? It makes no sense. Now, the caveat to all this is of course, do I think you can improve upon that? I do. This is just the base case, market cap rated. And by the way, the default, we always tell people, is the global market portfolio, meaning if you just went out and bought the world, you end up with about half stocks and half bonds, and of that, about half U.S., half foreign. That gives you a pretty amazing allocation that almost, I think will beat 80% of professional institutions going forward because you can get it for free. It's very simple to do that. You could do that with one fund today. You could do it with 2, 3, 4 funds. Replicate this for near free. That becomes the gold star default base case. And then to improve upon that, are there things you can do? I think so, certainly. But that's a really long-winded answer to your question.
Yeah, no, absolutely. It's perfect. I want to get into some of those other things that we can add on to and really dig into the Trinity portfolio. But for me, I think you nailed it on the head. The two big takeaways are, fees are probably the biggest mistake investors make, paying too much in fees. But the diversification side of it too is critical because, as you've pointed out, and as I see all the time, people own, investors maybe own several different 5, 6, even 7, 8 different U.S. equity mutual funds and think they're diversified.
Yeah.
And they have maybe 80% in U.S. stocks and 20% in bonds or cash or something and think they're diversified. You wrote a post recently where you talked about how you own essentially all your money's in one fund. And, you're vastly more diversified than the average investor. So, part of that's through the geographic diversification, but it's also through these, the different strategies. So yeah, let's talk a little bit about, that, the benefits of diversification and not just across different asset classes, but through these different strategies too.
One of my favorite, we joke often where we say, look, one of the best investment strategies is 2,000 years old, was written in the Talmud, where, I'm paraphrasing, it says invest a third of your labor into business, a third into land, and a third into reserve. So the way I interpret that modern is a third into stocks, bonds, and real estate. That portfolio alone is impossible to beat. It's such a good portfolio. It's over 2,000 years old. But the concept that you hit the nail on the head, so many times we see portfolios where people come to us and they say, hey, Meb, what do you think about this? And literally it's 20, 50, 100, 200 holdings. The average financial advisor, this is a stat, and we can source it, that's been in business for 20 years, owns 200 funds for his clients. How in God's name could you ever possibly keep up with 200 funds? And so this concept of false diversification, people think just by sheer number that they have diversification. And your example is incredibly apt, where you own a large cap fund and a mid cap and a small cap value, a small cap growth, mid cap value and growth and a mid cap or a large cap value and growth, you basically just own one fund, which is the S&P 500. So having true diversifiers and having them enough in a way to it really matters. So if someone gets off this and they're like, Meb, Jesse, great podcast, you convinced me to buy some gold, and they put 1% in or 0.5%, it's probably not going to do anything. And so having true diversification, the best example I give, and this of course triggers everyone, so apologies ahead of time, is most people, particularly in the US, consistently invest far too much in the US market, where the global default, that surprises everyone, is only half. So the U.S. as a percentage of world market cap is only half. That means by default, the starting point is you should put half in foreign stocks, and no one does. Everyone in the U.S. puts 70, 80% on average in the U.S., and it happens in every country around the world, though. If you're a Brazilian, you put all your money in Brazilian stocks. If you're Russian, you put it all in Russian stocks. If you're Italian, Chinese, Japanese, all the way down the list. And this is going back to your concept of diversification. It's a horrible idea. Just like no one would say, hey, should you put all your money in your employer's stock? No, that's a crazy idea too. Well, would you ever just put all your money in one stock? But people, for some reason, think it's fine to do it in just one country. And the problem is, if you look back, my favorite investing book, you mentioned earlier, is Triumph of the Optimist. And it goes back and looks at over 100 years of stock, bond, returns all over the world. And you see plenty of times where there's countries that did amazing. Sure, if you could go back to 1900 and pick the U.S., hey, pat on the back, you picked one of the best outperformers. It wasn't the best. I think tiny South Africa did better. But there were plenty that were worse. And in some cases, if you happen to live in Austria, you had basically zero return over the whole period, real return after inflation. Some countries went to zero. So this concept of putting too many eggs in one basket, I think is really dangerous for your core, and it is not a compensated concentration. So, thinking about how to invest, we always say that the default is the global market portfolio, but that's uncomfortable for many people. And, we say that's a starting point and think you could actually improve upon that from there. And you mentioned, how I put most of my money. We've been very transparent about how I invest my own money into one fund, and I think that's far more diversified than, it owns underlying 20 other funds that own 28,000 plus securities all around the world, not just diversified by asset class, stocks, bonds, commodities, real estate, also by geography, also by economic development. Tying back into what we talked about earlier, the U.S. is only a quarter of world GDP, and if you go down to population and other metrics, it's actually less. So I think it's really important to think long and hard about diversification, not only across geography, locale, investment, but also by strategy as well.
Well, and this gets into, one of the things you I guess utilize in the Trinity, portfolios is you add a value bent. And I think it's important to talk about value in terms of, the disparity between, valuations here in the United States and overseas. I mean, I think GMO has pointed out that, emerging value is like incredibly attractive relative to U.S. stocks today. But you wrote a piece recently that there's this disparity is at a 40-year wide, between U.S. and overseas. So this home country bias, could be more dangerous today than it's been in a long time.
It's funny. So you and I have lived through a few different cycles, and you start to see very similar behavior and reasoning and commentary. The names change, the asset classes change, but you start to see the same sort of takeaways where people love to extrapolate the recent past far into the future. So as an example, we talk a lot about valuations, and taking a step back, this is still a surprise to a lot of investors, where one of the amazing going back 50 years inventions of our lifetime has been this trend from high fee to low fee. Fantastic for investors. But most people think that the big invention, the revolution that Jack Bogle and others created was the index fund. And the challenge of that is, if you ask most investors, particularly young people, and you say, hey, you're going to go buy the U.S. stock market through an ETF or mutual fund, and you say, how is that how's that index weighted? And most people say, it's based on size. So you invest most in the large companies like Apple, which is correct. But then you say, size by what measure? And people say, well, the biggest companies are the ones with the most earnings and revenues. It's based purely on two variables. It's price of the stock times shares outstanding. And this is a surprise to almost every investor we talk to, where these market cap based indexes are based purely on price alone. And you can have no tether to fundamentals whatsoever. You could theoretically have a $1 trillion company that has no earnings, could theoretically have no revenue, but it's only based on the price of the stock. And so the beauty of a market cap weighted index going back 50 years was that you could manage it with no effort. So you literally just buy, say, 500 or 1,000 or 3,000 stocks, and you never have to rebalance it again. We're ignoring corporate actions, of course, but that's the reason it was being able to be delivered for such low cost, which was actually in a day and age of 2019, you can run almost anything based on low cost. But not my point. My point is market cap indexing, if you were an alien and you came down to the U.S., is a very curious way to invest your money. It is the market. It is the broad marketplace. But as an investing strategy, it really makes no sense. Why would you, any other part of our lives of personal finance, would you ever buy something without any regards to value? So you don't go to buy a house and say, I'm going to totally ignore the price to income ratios or the value of this house relative to how much I could rent it for, et cetera, et cetera, et cetera. Right? But people do it with investing, and it makes no sense. And let me give you an example. So going back 100 years, talking about Ben Graham, Warren Buffett, fundamentals are an incredible anchor from which you can decide to make investing decisions. And if you go back over time, investing in stocks has been a great proposition over very long periods, and we think that it's one of the best ways to build wealth over time. That having been said, on long-term basis, if you look at, say, P ratios, if you look at long-term 10-year ones, on average, countries around the world trade at about 17. But there's been times when countries trade as low as 5. There's been times, and the U.S. has been there, by the way, there's been times when they'll trade as high as 45, which is what happened in the U.S. in 1999 when I was at university and watching professors pause their lecture to go check the price of stocks on Yahoo Finance, or I guess it would have been Raging Bull, or look up the prices of Lucent Technologies and CMGI and Pets.com. It hit the highest valuation we've ever seen in the United States. Now, the craziness with market cap investing is that you invest regardless of value. So you put just as much money, if not, you actually put more in markets the more expensive they get, and you put less in markets the less expensive they get. And that doesn't make a whole lot of sense. So right now, a lot of people are saying, they heard it earlier, said, you put 80% in the U.S. So yeah, man, but the U.S. is a different market. It deserves to be more expensive. It deserves a valuation premium. It's far outperformed foreign markets. And so that's true. The U.S. over the past 50 years has outperformed foreign markets by about a percentage point per year. And that doesn't sound like much, but over time, that is a massive number. It compounds and gets so much bigger. And we love to tell people, say, okay, well, guess how much of that has come since 2009? And the answer is all of it. All the outperformance has come since 2009, where you had a scenario where the U.S. and the rest of the world were trading low teens price earnings ratios, March 2009. The difference is the U.S. crept all the way up to a value of around 30. So not as high as it was in the late 90s at 45, but high, traditional standards. The rest of the world hasn't participated, and that's paid out in stock returns too. So this tailwind in the U.S. has been a headwind for the rest of the world, but that's created these big alligator jaws where the U.S. is expensive and the rest of the world is cheap. The rest of the world is reasonable. So foreign developed is around 20, foreign emerging down around 15, 16. And the really cheap stuff, the cheapest quartile countries down around 12. So you have an opportunity to invest in the rest of the world somewhere between a 50% discount to the U.S. to a 66% discount. Now, valuation over time, it plays out over years and decades, not months and quarters. And so if you look at the history of market cap weighting, the problem right now, if you go back to what we're talking about, if you invested based on market cap weighting, that means you put 50% of your stock portfolio in the U.S. stocks right now, which is one of the most expensive stock markets in the world. Doesn't mean it has to crash. Doesn't mean it has to go down 90%. But likelihood is that it's going to be a headwind. We expect, by the way, as did John Bogle before he passed away, as did, you mentioned GMO, as well as about 12 other places, low single-digit stock returns for the U.S. Some say negative, like GMO, but we think low single digits is reasonable. But the rest of the world, the good news is cheap to downright really cheap. I think you can get double-digit returns in other countries. But the thing is, by market cap weighting, you put most of your money by, I think, 5 to 10 times any other country in the U.S. when it's one of the most expensive. And so market cap weighting overweights expensive countries, stocks, sectors over time. And the biggest example, so you mentioned the post where we talk about the biggest valuation spread in 40 years. Well, you go back 40 years ago, it wasn't the U.S. being more expensive than everything else in the world. The U.S. is cheaper. So in the 80s, the U.S. was cheap, and the rest of the world was a lot more expensive, and particularly one market, which was Japan. Old people listening to this will remember Japan was the biggest bubble we've ever seen, where it hit a P ratio of almost 100 and was the largest stock market in the world. So if you're a market cap indexer, you put you put most of your money into the most expensive stock market bubble we've ever seen. So again, come full circle, it doesn't make a whole lot of sense if you use a common sense standpoint to use market cap weighting because it exposes you to these huge bubbles. Now, there's many good things it does, and we can go down the list on what that might be. It forces you to own the big winners, the multi-baggers, the McDonald's, the Walmarts, the Amazons. But because it has no tether to value, if you use any other weighting methodology, it could be equal weight, it could be weight, whether the countries start with the letter A to M or N to Z, whether the CEOs wear ties or bow ties or no ties, doesn't matter. Any other methodology should outperform. Obviously, our favorite is valuation. Should outperform market cap weighting over time, but that gives you the opportunity right now to invest in these foreign markets, particularly when most people in the U.S. invest 80% in one of the most expensive stock markets in the world. I'm going to pause. You may have fallen asleep at this point.
You're
still there. You crashed your car. Are you at the gym, falling asleep?
No, I'm letting you run with it. It's perfect. And talking about it, it kind of leads me into the next topic, which is the U.S. stock market is expensive, and there was a book, I think it's The Tao of Capital, Mark Spitznagel wrote, where he showed that when you tail hedge, when the U.S. stock market is in its top quartile valuation, you can add significant, upside, a couple percent to your returns over time. Is that one of the reasons why you started the tail ETF? Was to kind of allow people an easy way to do that? Because tail hedging for most people is something I think that would make sense to people, but it's not easy to do. So, I mean, was that your inspiration behind it? Was because of where we're at in U.S. stocks, and how does the tail ETF really work?
So as you go down the list on things that I think people should do and what's important to them, I think the first step, like you mentioned, beginning of the podcast, was you should start with a diversified portfolio of assets that zig and zag. So to me, that's the global market portfolio, and a buy and hold investing approach across those assets is a great way. You can get it for free, awesome, tax efficient. Okay. The challenge for a lot of people with buy and hold investing, and again, we have a value tilt. So tilt towards companies and countries and sectors that are cheap versus expensive, the same way Warren Buffett or any other value investor would, to avoid these bubbles like I was mentioning that happen over time and distortions. And so you have this diversified portfolio, and that's done great over time. You get about 5% real after inflation, awesome returns. You'll lose a quarter or 30% of your money at some point, and that's the hard part for people. So despite having a diversified portfolio, you cannot find a portfolio that doesn't decline by at least 25% at some point after inflation. So a lot of people think, by the way, that bonds are magically exempt from drawdowns. They say, no, if you buy government bonds, you buy T-bills, you never lose any money. But after inflation, you lose 50% at some point, if not more. So building a diversified portfolio, great first step. But the problem that most people have with it is they feel like they're not doing anything. And the problem with buy and hold is that often when things are hitting the fan, so think back to the financial crisis, everything happens at the same time. So your portfolio is doing poorly, but guess what? The economy is also in a recession. Companies are going out of business, companies going bankrupt, real estate is going down, and oh, by the way, you may have just lost your job. So all of these things happen at the same time. So theoretically, having a portfolio that's exposed to economic growth does not hedge your life. And so your life being, hey, what do most Americans have most of their money in? Their house. So all these things went down at the same time. And so it's really hard for people to stick through a buy and hold approach with assets. So the next step we often talk about is trend following, which we could probably do a whole other podcast about, as an investing approach that, as far as I know, any advisors in the country, we have the largest allocation of trend following strategies of anyone, any institution or professional I know, where the default we have is half. And trend following, by the way, it means a lot of different things to different people. But the general basis is that it's also not easy to follow, because there's times when trend following looks great. So like in 08, 09, there's times it doesn't look great. So many years since, when markets may be going sideways or trend following gets caught whipsawing around, you have an exposure that is also not easy to follow, because you may look different than your neighbor who's just making hay by investing in the U.S. stock market the past 10 years. And so you look different, and that's also hard. That's really hard. There's no bigger investing challenge. Many people think it's greed and fear. This is a Warren Buffett quote, but the hardest one to probably deal with is envy. When your neighbors are making a lot of money and you're not, that's probably even more hard to deal with than a 2008 sort of crisis. So we put the two and two together, and that's the basis for what I do with all my money. So now we're getting to tail hedging. So we say that all these things you should do if you want to get rid of a risk. The first thing you should do is just not take it in the first place. If you own too much stocks, sell some. Get down to your sleeping point where you're comfortable with your stock exposure. Diversify across geography, strategies, trend following, for us, value. Once you've done all these things, there's still the case where a lot of people have too much exposure to U.S. stocks. So think a broker at Merrill Lynch. Think anyone who has exposure to U.S. stocks, maybe they own some in their retirement account and they just can't hedge or can't sell, or they have low-cost basis stock they've owned forever. They bought Apple at $5, now it's $1 trillion company. They don't want to sell, they'll get killed in taxes. And they say, look, I don't care if I make 8% a year or 9% a year. It's not going to make a difference to me, but it will make a difference if it goes down 25, 50, 80% like stocks have in the past. So for some people, the same way that buying car insurance, by the way, buying car insurance and buying house insurance is not a good investment for the vast majority of people, because you don't get into wrecks and your house doesn't burn down. So it's a bad investment from a purely financial standpoint, but it's a good investment from a psychological and emotional well-being, absolutely. Because you could be the one out of 10,000 people whose house burns down. Believe me, I live in California. Mudslides and fires are a very real occurrence. You could be the person who, that dummy was on their phone, went through the intersection and T-boned you. Maybe you did the same, maybe you weren't paying attention and you get into a car accident. So insurance is a vehicle that the biggest development evolution in my career has been that the statistical best portfolio or investment is not necessarily the correct one. Meaning, from a behavioral standpoint, from a success, from a sleep through it, happiness, stick with it standpoint, having an investment that increases your odds of compliance and achieving your goals is a worthwhile investment. So in this case, we launched a tail risk fund, which oddly has been our most popular fund this year, that does nothing more than it buys a bunch of puts on the U.S. stock market and pairs it with government bonds. And historically, in the modeling, it's actually had a slightly positive return, but I would not expect it to. It looks somewhat like an inverse S&P fund over time, but the bonds the income of the bonds, which historically was 4 to 6%, which is now 2 and going south quickly, covered the cost of buying puts on the stock market. So for some people, it's a wonderful hedge to what they're doing. If you go back to Q4 2018, for some people, just to see if the market and their portfolio is down 1, 5, 10%, to see something that's green helps them. It helps them get through, helps them to reduce the volatility of the day to day. So I think it's a fund that I own, my company owns. So we mentioned financial advisors are probably 4 times leveraged the stock market and don't know it. I think it's an investment that it's not one that we say is appropriate for everyone all the time, but could be appropriate for a lot of people to help them out.
Is there like and I was, looking at, because, I've got a friend who bought a ton of, blue chip names back in the 70s and just was, pushing a bunch of his, extra income into the market at that time. And he still owns all these stocks, and essentially, so everything he has is capital gains. And so, he doesn't want to, take a big tax, hit on selling those things, but he wants to reduce exposure. So something like tail makes a good deal of sense in that situation. Is there like a recommended kind of, exposure, say you have $10,000 worth of equity exposure, how much tail should you buy to kind of protect against that? Is there kind of a range?
There's sort of infinite ways that one can think about, permutations of investing and, what's the best collateral? How should you do it? I mean, the way we built it was the simplest. And for the nerds out there who want to go play around with the data, CBOE has a lot of bond and derivative options indices. You can tease out the data. We actually spent an entire summer building an options database before realizing it was actually fairly simple and you could replicate it within an afternoon with a nice coffee. But we did it, which made me feel comfortable with taking it back a long time. The reality was the way that we've designed it ends up, roughly speaking, and you obviously can't guarantee it, but it looks like a roughly 1 to -1 correlation with the S&P 500. So in any given month, day, quarter, if the S&P was down 10%, we would broadly expect this fund to be up 10%. Now, the reason we think it's superior to, say, a simple futures fund is that you do get the exposure of the options when volatility rips. So if you do have a tail event where volatility goes from 15 to 50 or 100, you get the added push of the options. But also on the flip side, of course, if you're buying this when volatility is at 100 after the event's already happened, right, you're probably going to get the other side of that double-edged sword too. So if you wanted to do it on your own and not outlay a ton of capital, you could certainly do it with your own options, futures, and get the massive amount of leverage. The way we did it was a little more plain vanilla. It's almost a bond replacement. So if you have in your portfolio, say, a 20% allocation to U.S. Treasuries, you could actually replace it with this fund, which would give you a 20% allocation to U.S. Treasuries, but also an overlay of a bunch of puts. So it's kind of 2 funds in one. 90% of it, again, is in roughly 10-year bonds, which ironically have had a fantastic year. Not a lot of people would have predicted bonds having for long-term up 20%, I think, this year. Zeros are up probably 30 or 40. But crazy times we live in. Anyway, so we expect roughly a 1 to -1. So if someone had 10,000 and they wanted to try to completely insulate, then it would be a roughly equal weight investment. So 10,000 as well. Yeah. But you don't have to completely insulate it. In many ways you could do 5, 2, 1. It's really personal preference. Yeah,
it makes perfect sense. I got to, there's a lot of studies that you've looked at. And actually one I got to thank you for, because when I started looking at gold back in like mid 2015, and one of the things that helped me kind of decide to make a significant commitment to it was a study that you did where you showed, when asset classes are down 2-3 years in a row, negative, you have negative return. I think gold at that point was 4 years, negative in a row. And usually it's a sign that, there's going to be a turnaround and returns going forward are going to be a little bit better than average. Is there anything specifically that, in terms of those types of studies that you're looking at today that, you think people should be aware of?
Couple comments. One is, I think it's really important for investors. I'm a quant, so it's a little easier, but I still feel the tug of emotions where you want to come into this whole world being what I call asset class agnostic. And the problem with so many investors is they identify, they say, I'm a gold bug, or I'm a dividend guy, I'm an income investor. And as we all know from the literature, once you buy something, you have a very different perspective on it, whether it's that bike in your garage or whether it's that stock you bought than before you bought it. Totally different perspective on investments. And we do this thing called the zero budget portfolio, where so many investors come to us again with 20, 50, 100 things. They say, Meb, what should I do? And they say, well, what should I do with the stock? Or say it's even gold. What should I do? Should I sell it? Should I keep it? And first of all, I said, you shouldn't have to think binary. It doesn't have to be all in, all out. But what would you do if you didn't own it? Would you go buy it? I said, no way. I would never buy that now. Or, well, okay. So for the investors listening, a great exercise, take out a blank piece of paper and say, what is my ideal allocation? Is it 50% in stocks, 25% in bonds, 25% in real estate ETFs? Whatever it may be, write it down, compare it to your current allocation. And if it's different, there's a problem. And the problem is you have some sort of emotional attachment to your portfolio. And in many cases, most of them we see are garbage, right? So now this is ignoring taxes, of course. But first comment is I think it's important for people to be asset class agnostic. And the reason value investing works, and by the way, I love CAPE ratio. I love valuation metrics. The valuation metric does not matter. You could use long-term dividends. You could use long-term cash flow. You could use price to book, price sale. It doesn't matter. In general, when you have a cheap market like Russia, every valuation indicator says the same thing. And by the way, listeners, Russian stock market has been outperforming the U.S. for going on 5 years now. But it has P ratio still single digits. When you have an expensive market like the U.S., every single valuation market says indicator says the same thing. You cannot. I challenge you, listeners. I'll buy you a beer if you find one. You got to be in Manhattan Beach or when I run across you. But you cannot find a valuation indicator that says the U.S. stock market is cheap. You cannot find one. But it's a challenge again. It's a beer bet. You find one, I'll buy you a beer. Because valuation metrics are blunt tools. One may say, hey, it's kind of expensive, and one says it's really expensive, but very rarely is the case that says something is super cheap or super expensive. But the dirty secret of valuation is that valuation simply correlates a ton with how much an asset is already down. So if you look at the price to earnings ratio, what moves in that equation? It's the numerator, price. So if you draw a chart of the 45 countries around the world, and you line up the P ratio and you do a regression against drawdown, not surprisingly, the expensive countries are all trading near all-time highs, and the cheap countries are already down 40, 60, 80%. And so when you're investing in cheap P ratios, it's simply because that market's already gone down a ton. Look at Russia, look at Greece, look at half of Eastern Europe. So there's a very high correlation with simply losses and valuation and then future returns. So as an example, we did an old study, took the French Pharma data back in the 1920s. Look what happened when you bought sectors or industries that were down 3, 4, 5 years in a row. This was actually in our first book, the Ivy Portfolio. We looked at what happened in broad asset classes. So U.S. stocks, foreign stocks, gold, bonds, when they were down multiple years in a row. And I think when you look at 3 years in a row, it had only happened when we published the book like 6 times. And the future 2-3 year returns are really strong. Massive outperformance. But the problem is nobody wants to own something when it's down 40, 60, 80%. But that's when they want to sell. And buddy Mark Yusko says there's no other industry in the world where when things in the store go on sale, investing, everyone runs out of the store. It's crazy when you should be doing the opposite. So we did a fun study that looked at also what happens when you buy sectors, industries, countries when they're down 60, 80%. And the future returns were great. And so we did a couple old fun posts where the first one was a few years ago. We said why you should ask for coal stocks in your stocking this year for a holidays, Christmas. Cold stocks were down like 80%, down like 5 years in a row or something. And usually by the time an industry is completely hated, no one wants it, it's a good opportunity. So if you look around the world today, oddly enough, there's still quite a few cheap countries. I think the cheapest bucket, you mentioned massive valuation spread. It's an unbelievable opportunity to diversify away from the U.S. towards foreign markets, towards the really cheap foreign markets. And that gives you, it's not just emerging. If you had to pick one, it would be emerging markets. But the cheapest countries are about half in developed as well. You got to diversify. I guarantee you, if you your takeaway from this podcast is to go put all your money in Turkey, I will scold you. That is absolutely not what I said. You still got to diversify because some keep going down and some will have great returns. But on average, that value bucket absolutely outperforms the U.S. And then within the U.S., you have some pockets. I think the agriculture stocks have been just a dumpster fire for going on 5 years, 7 years now. Going into this year, certainly I think a lot of the precious metals, gold miners had been very unpopular, but they're having a pretty monster year. So I think it's good territory to do some digging. I think the challenge for a lot of people, we joke, there's still a fair amount of risk. The old quote, what do you call something down 90%, something down 80%, then goes down another 50%. So just because it's down 80% doesn't mean it's going to, keep going up. But on average, that's been good places to look, buying where there's blood in the streets. And if you pair that with valuation thoughtfulness, I think that's a really powerful combo. And my favorite, of course, is when something's cheap and entering an uptrend. So you have the fundamental anchor of it being cheap through whatever value metric you want to use. And then once you can use any sort of quantitative variable, 200-day moving average, anything simple like that, to define it as an uptrend, that's the best confluence of possible outcomes. And it's true in the U.S. stock market too, by the way. If you were to divide the U.S. stock market into quadrants for its full history, cheap, expensive, uptrend, downtrend, not surprisingly, the worst is expensive downtrend, and the best is cheap uptrend. But the second best is expensive uptrend, which is where we are now. But that flips to being the worst, by the way, if and when you ever enter a downtrend. So it's a simple answer. There's always an opportunity somewhere. I think if I had to choose, and this is what I do with my son's retirement college account as well as my retirement account, because I can't invest in our own funds. They both just dollar cost average into foreign and emerging market stocks. Yeah.
I mean, there's just, so many different opportunities out there that people are just focusing, on an S&P 500 or missing out on. And I totally agree with you. I think the industry is moving towards this low cost thing. It's really cool to see, but I think the next stage of it is people moving more towards a lot of these strategies that you're talking about and that you're implementing in the funds. So, where can people find out more about Cambria and follow you in your writing?
All right. So you got my day job, which would be CambriaInvestments.com, or the funds at CambriaFunds.com. You can go find all of our ETFs. You can find my old blog at MebFaber.com, which is mostly podcasts these days, like yourself. Love this medium. We could go on for hours. You can watch me pick fights on Twitter. And again, that's at Meb Faber. And if you want to download our books, we got like 3 or 4 for free at CambriaInvestments.com. Download them. Let me know what you think. I would love to hear some feedback.
Yeah, and I highly recommend people check out the books. I think they're phenomenal, and they really do fill a void for people just trying to understand a lot of these concepts that are critical to succeeding. So, Meb, thank you so much for taking the time, man. This was awesome.
It's been a blast. Thanks for having me.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.